Good to see you guys. Appreciate it. Good to have you back on set, David.
Thanks for having me.
We've known things were going to be thin and choppy, and today's just one more example.
Exactly. I mean, I think if you take a step back from what we're seeing in the current environment, it's still all about interest rate volatility. And until investors can figure out what's going to happen with inflation, what's going to happen with the Fed, capital markets broadly are going to be bouncing around. And so obviously we're dealing with a liquidity issue, thin volumes at the end of the summer, people hopefully taking the remainder of the week off. But I'm not sure that this is going to subside when people come back from the Labor Day holiday.
Yeah. Binky, any reason to think seasonals in September this year will be different?
I would argue no. Most importantly, the fact that we are basically coming off of what was basically the fourth, big rally that we've had in this bear market since the beginning of the year. And I would argue, that rally was basically driven by a squeeze on systematic strategies positioning. So we get the Fed, equities, move down, vol goes up. And I would argue the way that the systematic strategies basically respond, it's going to extend a little bit over time. So September seasonality should, be driven. We're coming in on the downside. So I would argue it basically continues. Seasonality is typically better October to December.
So, Binky, I know you think that positioning is low, more squeeze is likely in the future. Is that true even after the bear market rally we just saw? You don't see much in the way of capitulation on that short covering?
I would say, a squeeze is definitely possible. I would emphasize that, in our read, when you look at our overall equity positioning measure, it's sort of now in the middle of the lower half of, the typical historical range. The rally from, mid-June was really off of, the lows and the bottom of the range. And I expect, given what's happening, that positioning measures, basically moved down again. So, it's definitely very possible. I would argue that basically, if you think about the October to December period, we've got basically, a short run sort of, pickup in growth. If you think about GDP growth, we're talking about a pickup in GDP growth in the third quarter relative to the second. If you look at GDP trackers, they're all sort of picking up. We've got basically the favorable seasonals. We've got, the midterm election. We tend to see the market go sideways to down basically in the run up. And post the midterm elections, the market has typically rallied. I would say, all squeezes from here, they're of course, catalyst and data dependent, but, sort of aligning to, a reasonable case, thinking 1 month forward of a squeeze into a year end. Yeah. And, I would remind that basically, bear market rallies are frequent and large. This, as I said, is the fourth one. The two recessions prior to the pandemic, we had, 5 each. And these are, rallies that were bigger than 5% off of new lows. We had 5 that averaged, 14 to 15%. So,
right.
So the possibility of squeeze very high.